we're jumping straight into Poet Technologies today. Everyone is watching the price action, but the real story is their sudden revenue acceleration and the massive hedge fund accumulation behind the scenes.
Exactly. You're tuned into the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us.
Make sure to subscribe and hit the like button so we can keep simplifying these market moves for you. And let's just get right into it because Poet Technologies is, well, they're absolutely everywhere on the financial feeds right now.
Oh, yeah.
I mean, if you've spent any time looking at the markets this week, you've likely seen the headlines tagging them as this, high-stakes play on a photonic disruptor.
Right. The hype machine is definitely running at full capacity.
It really is. But our goal today is to cut straight through that surface-level AI buzz. We are going to dig into the actual SEC filings, confront the harsh realities of their balance sheet, and figure out what proprietary technology is actually driving all this momentum.
And that is the perfect approach because the surface-level data is surprisingly deceptive right now.
Deceptive how?
Well, if you just scrape the recent news algorithms, the quantitative sentiment scores across the board are coming back as strictly neutral.
Just neutral, with all that buzz.
Technically, yeah. An algorithm reading the headlines just sees a flat story. But when you bypass the bots and dig into the actual market mechanics, there is a quiet, cautious optimism building up under the surface.
Interesting.
We are seeing a series of massive, under-the-radar catalysts that those basic sentiment trackers are completely failing to register.
So let's break down what the bots are missing, starting with the bull case. We have to talk about the revenue growth, because looking at the recent Q3 2025 earnings print, one specific line item practically jumped off the page at me.
The product revenue.
Exactly. Their non-recurring engineering and product revenue hit $298,434. Now, I want to play devil's advocate for a second here.
Go for it.
We cover the tech sector a lot. Trillions of dollars flow through this space daily. Why is Wall Street suddenly obsessed with a company bringing in roughly the price of a mid-sized house in a single quarter?
Let's break that down even further. It sounds like a statistical rounding error when you frame it against the broader tech sector. But context is everything here. In the quarter immediately prior to this one, their revenue was a mere $3,685.
Wow.
Right. We are talking about jumping from under $4,000 to nearly $300,000 in a single quarter. This isn't just a gradual organic increase, it's a massive percentage jump that signals a highly anticipated transition for the business.
A transition from what to what exactly? Are they finally out of the testing phase?
Spot on. For years, hardware startups like this live in what the industry calls the valley of death.
Right, the pure research and development phase.
Exactly. They burn cash in the lab with nothing to actually sell. That sudden revenue jump points to an accelerating commercial demand. They're finally stepping out of the R&D lab and proving they can actually scale their optical engine products for paying customers.
And the market is entirely forward-looking. Wall Street doesn't pay a premium for what you did yesterday, right? They pay for what you are going to do tomorrow.
Always.
And the forecasts I'm seeing attached to the scaling process are staggering. Analysts are currently projecting a 146.1% annual revenue growth.
Which is huge.
Yeah. And on top of that, they're modeling a 91.8% annual earnings per share growth. So they're forecasting that this company is about to scale at a breakneck pace. But, forecasts are just numbers in a spreadsheet. What is the actual product driving this confidence?
To understand the confidence, you really have to understand their technological moat. The core product driving all of this is their optical interposer platform. It is a proprietary intellectual property-protected system that uses integrated photonics for AI connectivity.
Okay, integrated photonics for AI connectivity sounds fantastic in a corporate press release, but let's translate that for the listener. What does this technology actually do inside a server room?
Think of a traditional data center like a sprawling, heavily congested city. Right now, all the data inside those servers travels on traditional copper wire highways.
Right.
It is slow, there's a ton of physical friction, and because of that friction, it generates an incredible amount of heat. Data centers are currently struggling with two monumental bottlenecks. First, how to move data fast enough for modern AI tasks.
And second, how to do it without melting the servers from power overload.
Exactly. What Poet's optical interposer does is essentially rip out those congested copper roads and replace them with a network of high-speed fiber optic bullet trains. It uses light instead of electricity to move the data.
That analogy makes it click, so it dramatically speeds up the data transfer while simultaneously dropping the temperature and power requirements. But here is my pushback. They aren't the only ones making optical technology. In that booming AI data center market, who makes the traditional silicon photonics right now? It's the legacy giants. Companies like Intel and Cisco.
Oh, absolutely.
So POIT Technologies is stepping into the ring and fundamentally challenging the architecture used by the most powerful infrastructure companies on the planet. How do we know their bullet train is actually better than Intel's?
We don't have to guess because there is serious objective industry validation happening.
Mm.
Just recently, on February 12, 2026, this specific optical interposer technology won the Lightwave Award for Advanced AI Connectivity.
That's a major industry nod.
It is. And what makes that detail carry so much weight is that it wasn't a one-off stroke of luck. This is the second year in a row they've taken home this specific award.
Back to back.
Back to back. When you get that kind of industry recognition, it acts as an undeniable validator for their IP. It proves to potential buyers that the tech works, which helps defend their market share against those legacy titans you mentioned.
So you combine a staggering revenue acceleration with an award-winning technological moat that solves a critical power bottleneck. It starts to make sense why the smart money is waking up. We saw a major institutional momentum shift just recently in the filings.
The MMCI filings.
Exactly. On February 24th, 2026, a Securities and Exchange Commission filing revealed that the hedge fund MMCIP took a significant stake in the company.
And that is the exact catalyst the algorithms missed. When a player like MMCIP steps in and takes a heavy stake, we call that institutional cluster buying.
Right, because hedge funds do not throw capital at a sub-million-dollar revenue company purely on social media hype.
Never. They have teams of engineers tearing apart the patents and modeling the supply chain. That SEC filing is a beacon to the rest of the market. It perfectly explains the surging volume and breakout momentum in the stock's price action. The retail crowd is buzzing, sure, but the institutional whales are the ones quietly accumulating shares, which completely offsets that neutral algorithmic sentiment we touched on earlier.
Looking at the flip side, we have to ground this conversation in some harsh reality.
Financials.
Yeah, the balance sheet. If we look at the historical financials, it is an absolute bloodbath. I mean, despite that impressive Q3 revenue jump we just celebrated, their historical annual revenue has hovered around $40,000.
It's extremely low.
And while pulling in 40 grand, they managed to post a net income of negative $56.7 million. Negative 56 million on 40 grand of revenue. If I ran my household budget with those margins, the bank would have taken my house, my car, and my dog by now.
Yeah, they wouldn't let you get very far.
How are they even keeping the lights on?
It is the ultimate tightrope walk of a hardware disruptor, and it highlights a glaring execution risk. Developing hardware requires fabrication facilities, intense physical testing, and immense upfront capital. You can't just iterate a physical microchip over the weekend like you can with a piece of software.
That's a great point.
That negative $56.7 million represents the brutal cost of entry into the semiconductor space.
And the margins emphasize just how deep that cost of entry goes. I was looking at their earnings before interest and taxes, their EBIT margin. It sits at negative 6,246.4%.
Ouch.
Right. That means for every dollar they historically brought in, they were burning over $62 on operations. Add to that a negative free cash flow of negative $3.2 million per quarter. They are incinerating cash to fuel this growth. If their production ramp-up falters for even a week, or if there is a single hiccup in their supply chain, wouldn't that burn rate just bankrupt them before they can scale?
That is the existential threat they face every single day. To survive those phenomenal losses, the company is relying entirely on its liquidity. Now, to be fair to their management team, they aren't completely running on fumes yet. They currently have $13.5 million in cash and equivalents sitting on the balance sheet.
Okay.
They also maintain a current ratio of 2.3.
So with a healthy current ratio of 2.3, they've got a bit of breathing room. They have more than enough short-term assets to cover their immediate liabilities, keeping the wolves from the door while they try to scale.
Right. Gives them the necessary runway. It means they can continue to aggressively absorb that negative free cash flow, reinvesting it into R&D and manufacturing capacity without having to immediately dilute shareholders or take on toxic high-interest debt. They have structured themselves to survive the sprint, provided they don't hit a major roadblock.
But the roadblocks are literal giants. I want to remind you, the listener, who they are actually up against, they are competing against colossal, incredibly well-capitalized rivals in the silicon photonics space.
The Goliath.
Exactly. When financial media slaps them with the risky bet label, that label is fiercely earned. They are a tiny player trying to disrupt an entire global infrastructure system dominated by tech titans. If I am running an AWS or Microsoft data center, am I really going to rip out my entire legacy Intel or Cisco architecture to take a chance on a company that just celebrated making 300 grand? It seems like a colossal uphill battle.
That is the multi-million-dollar question, and it is exactly why the broader market remains cautious. The institutional money might be buying, but the broader market is looking at the execution risk and asking, yes, your tech is award-winning, and yes, it saves power, but can you manufacture it at a global scale?
Can you guarantee supply?
Exactly. You don't just walk into an infrastructure monopoly and ask them to politely step aside. The risk of being outproduced or outmarketed by a tech titan is heavily priced into the stock right now.
So, with all of these moving parts, the incredible award-winning potential on one side and the terrifying cash burn and competition on the other, what should you be looking out for over the next 30 days? We have a very specific catalyst calendar shaping up. First and foremost, you need to circle the Q4 2025 earnings report.
The big one.
It is expected right around March 30th, 2026.
This upcoming earnings call is going to be the crucible. The market expectations are already set in stone. The consensus earnings per share is expected to be negative $0.06. Now, that is a significant improvement from their trailing EPS of negative $0.72.
So they are dramatically slowing the bleeding.
Yes. And on the revenue side, Wall Street is looking for around $386,000.
Which makes this the ultimate test of their narrative. The entire market, from retail day traders to the analysts at MMCIP, is waiting to see if that Q3 acceleration was just a fluke.
A one-time blip from a single client.
Right. Or if it is the beginning of a sustained, undeniable trend toward commercial profitability. If they miss that $386,000 mark, the narrative falls apart.
Without a doubt. And aside from the raw earnings numbers, there are strategic partnerships and macro trends that require close attention. For instance, POET Technologies has an ongoing collaboration with quantum computing, focusing on building out next-generation photonic AI systems.
That's a huge sector right now.
It is. You need to monitor any expansion announcements regarding this collaboration, especially as we head into the spring industry conferences. When a separate cutting-edge computing company partners with them, it acts as a secondary validator. It proves that other engineers in the space view the optical interposer as the real deal.
And we can't ignore the broader macro environment either, because the wind might be shifting in their favor. We are seeing rising expectations across the board for interest rate cuts. And historically, when rate cut expectations rise, we witness a powerful sector rotation.
Capital flows out of safe, defensive positions and rotates aggressively back into high-growth, risk-on sectors like semiconductors and photonics.
Why? Because lower interest rates mean borrowing money gets cheaper, which makes the market far more forgiving of companies with negative free cash flow.
That is a crucial point. When capital is cheap, investors are willing to fund the valley of death longer to see the tech materialize, especially when that tech is fueled by the endless, insatiable build-out of AI data centers.
Which is everywhere.
Every major tech CEO is warning about power grid limitations. They're all desperately trying to build the infrastructure for artificial intelligence, and they all fundamentally need the power-saving bandwidth that POET Technologies is offering. That macro rotation, combined with the AI infrastructure boom, could act as a powerful tailwind, lifting the stock regardless of the day-to-day micro-volatility.
Well, we've covered a tremendous amount of ground today, from the dizzying percentage jumps in revenue to the terrifying realities of their cash burn. It's time to bring it all together. Here is the lowdown. POET Technologies is the ultimate high-risk, high-reward play. They are currently navigating the treacherous transition from a pure research lab into a commercial manufacturing entity. And they are doing this at the exact moment when global AI infrastructure is screaming for a solution to their power and heat bottlenecks.
If modern AI data centers are entirely bottlenecked by power consumption and bandwidth, and POET Technologies holds the back-to-back award-winning key to solving that physical limitation, the biggest risk moving forward might not actually be Intel or Cisco.
What is it then?
The biggest risk might be what happens if they simply cannot manufacture their optical engines fast enough to meet the demand they've just unlocked.
A phenomenal question to keep in mind as we head toward that March 30th earnings call. Thank you for joining us on this breakdown. Make sure to stay tuned to the Easy Money Show for our future market breakdowns. We'll see you next time.